Imagine building a billion-dollar empire out of nothing but smoke, mirrors, and the unshakable confidence of a man wearing $800 cufflinks. Now imagine watching that empire crumble in real time while its top brass bail out in golden parachutes, leaving employees, investors, and pension holders to pick through the ashes. Welcome to the Enron saga. Let's rewind to the 90s, a decade drunk on dot-coms and deregulation. Everyone was getting rich, or at least pretending to. And in Houston, Enron Corporation was leading that charge, presenting itself as the slick, modern face of energy. What do you get when you mix Wall Street arrogance, cooked books, and a CEO with the moral compass of a Bond villain? You get Enron, America's favorite corporate cautionary tale. Before FTX, before Lehman Brothers, there was Enron. The energy giant that wasn't really about energy, and definitely not about honesty. This is the story of how a company valued at $70 billion evaporated overnight, dragging thousands of employees, investors, and pensions down with it. Today on The Ledger, we crack open the accounting shell game that turned Enron from Wall Street darling to poster child for corporate fraud. Subscribe to this channel. Let's dig into how lies became assets, and how one of the biggest frauds in US history went unchecked. Until it didn't. They started as a humble natural gas pipeline company. But that was too boring. CEO Jeff Skilling had a better idea: reinvent Enron into a digital-age, asset-light energy trader. No pipes, no product, just deals. Enron wasn't in the business of energy anymore. It was in the business of potential. The business of hype. Under Skilling's vision, they launched Enron Online, a digital trading platform that turned energy into something speculative, like pork bellies or crypto. Enron could sell gas it didn't yet own to a buyer who didn't need it, and somehow make money in the process. You know, totally normal things, and Wall Street. They ate it up. They didn't care that Enron's books were starting to look like a choose-your-own-adventure novel written by a drunk accountant. As long as that stock price went up, everyone was happy. Until it didn't. The early 2000s weren't kind to over-leveraged hype machines. Enron's mask began to slip. Behind the scenes, Chief Financial Officer Andrew Fastow had been playing financial Jenga using shell companies, lovingly named Raptors and LJM1, to hide debt and inflate earnings. These weren't clever financial instruments. They were straight-up lies duct-taped together with accounting gimmicks. Fastow, for the record, thought he was a genius. And for a while, Wall Street agreed. Skilling and Lay kept the facade going, even as cracks formed. When Skilling abruptly resigned in August 2001, citing vague personal reasons, insiders should have smelled blood. But instead, Kenneth Lay, the company's founder, waltzed back in to steady the ship. Spoiler alert, Lay didn't steady anything. He kept lying. Internally, Lay and Skilling had been selling off hundreds of millions in stock while employees were locked out of their 401(k)s, many of which were 100% Enron shares. Imagine watching your retirement evaporate in real time while your CEO cashes out and grins for the cameras. Then, the Wall Street Journal dropped a quiet bomb. A few journalists started asking uncomfortable questions. Where's the cash flow? Why are these subsidiaries so conveniently structured? Enron's execs started sweating. And investors started fleeing. By October 2001, Enron admitted it had overstated earnings by nearly $600 million. That's not a rounding error. That's fraud. And remember those shell companies Fastow cooked up? Yeah, they were technically off the books, but only if you lived in a world where math didn't exist. Now, here's where the story goes from shady to full-on tragic comedy. Dynegy, another energy company, tried to buy Enron to save it. The proposed price? $8 billion in stock. Which, in hindsight, was like buying a collapsing tent and hoping the wind dies down. Turns out, in the 50 days leading up to the deal, Enron had burned through $5 billion in borrowed funds. That's billion with a B. In 50 days. Even Dynegy didn't see that one coming. When they found out, they noped out of the deal faster than you can say due diligence. That day, credit rating agencies downgraded Enron to junk status. Enron stock 61 cents. For a company once worth $70 billion, on December 1, 2001, Enron filed for Chapter 11 bankruptcy, the largest in U.S. history at the time. Over 4,000 people were laid off, many with 30 minutes notice. The 401k plans? Gone. Employees had invested at $80 per share. Now it wasn't even worth the paper the certificates were printed on, and then came the reckoning. Skilling, convicted of conspiracy, securities fraud, insider trading. Originally sentenced to 24 years, later reduced to 14. He walked out of prison in 2019 and, get this, tried launching an oil trading startup. That flopped in record time. Fasto. 6 years in federal prison, now gives ethics talks. Irony level, maximum. Leah Fasto, his wife and fellow fraudster, served a year for wire fraud and helping file false tax returns. And Kenneth Lay? Well, he died of a heart attack before sentencing. Convenient, the employees. They sued. They won $85 million, on $2 billion lost. That means each person got around $3,100. Enough for a nice vacation. Just not retirement. The collapse of Enron led to something rare, actual government action. Congress passed the Sarbanes-Oxley Act in 2002. New oversight boards, mandatory financial disclosures, executive. Required to personally sign off on reports. Basically, no more pretending. Today, Enron isn't remembered for innovation or energy markets. It's remembered as a cautionary tale. A masterclass in corporate arrogance. They believed they could fool everyone forever. That revenue could be imagined. That growth could be faked. That accountability was for lesser mortals, but here's the truth, numbers don't lie. People do. Enron didn't just fail. It imploded in a way that took careers, pensions, and faith in the system with it. All because a few smart guys thought they were too smart to fail. This wasn't just a scandal. It was a symptom of a system that rewards deception, punishes transparency, and runs on the illusion of endless growth. Enron didn't just collapse, it cratered trust in corporate America. It gave us new laws, a lot of broken dreams, and a reminder that greed in a suit is still greed. If you learned something today, or just enjoyed watching billion-dollar frauds get exposed, hit that like button, drop a comment, share to people that are also interested, and subscribe to The Ledger for more real stories from the dark side of money, power, and corruption. And remember, when a company says, "Trust us," the numbers are solid. Maybe read the footnotes. This is The Ledger, and that was Enron. See you in my next video.